Hi, I'm Rick Day, and this is Optimum Success. This is segment 12, Keep Your Money. We all want to keep as much money as we can, presumably, probably for a couple different reasons, but the prime reason most people is because they want to be financially independent and basically be able to do what they want in their older age and not sweat about money. That's the number one. When I was a business consultant early on, I thought that was everybody's reason. I came to find out there's some exceptions to that. For instance, family farms, family forests, they're trying to maintain a lifestyle, a way of life for multiple generations. That is a small exception. Most of us are trying to keep our money, sock it away, make money with our money so that we don't have to worry about money someday and we can do what we want to do. In our case, we like to travel and we like to shop, unfortunately. But the travel is good, the shopping, hey. So what do you do to save your money, to keep your money? You eliminate waste. So in your business and at your home, eliminate waste. And that often has to do with materials. Sometimes it has to do with time and redundancies. Eliminate waste. Eliminate headaches. If you're in business, we kind of talked about this before. Bad customers, bad vendors. They're wasting your time or they're wasting your staff's time, which costs you money. So eliminate waste in different ways. Eliminate equipment that isn't working for you. It's not producing enough income to pay for itself and make you a profit. Or is that equipment old and tired and are you having to put a bunch of money in it to repair it? And would you be better served by something that was more efficient and cost you less to maintain? That's something in business, especially in manufacturing and in other industries, trucking for instance, driving taxis, limousines, transportation, and manufacturing certainly. You've got to make sure that equipment is operating efficiently because downtime not only is not making you any money and you're going to cost to repair something, but you're usually ticking off your customer on your downtime because you're not doing what you were supposed to do. Invest in items. Invest in items that produce revenue, and again, pay attention to the break-even and the ROI. Taxes and saving money with taxes. So as you probably know, the 1040 is the normal long form for people. Businesses do other forms, partnerships do other forms, but in the personal return, you have schedules A, B, C, D, E. E is for rental properties, C is for small business. You have your Schedule A for your itemized deductions, but I want to concentrate mostly on E and C. C for your small business deductions and E for your rental properties. I suggest to you, if you aren't familiar, you print out, go to the IRS website, print out a C and an E, and then when you pay attention to where your expenses are and what you're doing, you'll see exactly the way it's going to be filed when you file those returns. So that's very helpful. On Schedule E's, you can afford, it's not a matter of what you can afford. The government will allow you to write off $25,000 a year. Now, if you go back in history, to people that owned big buildings in Manhattan and other places in the country, some of the people you go back a couple of generations that made a fortune, you might have even heard stories where the butler paid more taxes than the bazillionaire, right? They changed that. I believe it was in the early 70s in the Nixon administration, if I'm correct. What they did is they put a cap at $25,000 on your property losses. But still, it's $25,000 of income, in essence, you're writing off. And on rental properties, you have maintenance, but you also have depreciation. So that is a useful deal on your Schedule C's for your small business, all your different things that you're doing out there that you might be doing anyway that are business expenses that are legitimately to write off as business expenses are going to save you money. I suggest if you're a couple or roommates, partners, however that may be, that one of you be a W-2 employee and the other person be the entrepreneur. And maybe you initially have two W-2 employees and then somebody slowly starts their side hustle or their business that doesn't occupy all their time, or they're setting the legs up for the business. Then inevitably they become the entrepreneur. The other person has a steady W-2 income. Now the problem with W-2 income is what? The problem is the tax man takes all your money out of your check every time you get a check. If you're a business, you take care of that unless you're paying estimateds because you made too much money the previous year. you're doing it at the end of the year. You deduct all your expenses, and then you figure out what your net is, and then you're paying on that net. I tell people in Oregon, which is a very high tax state, I tell people that if they're in Oregon to just plan to give up a third of their net between the feds and the state. It's just a quick, easy way to look at it. So the less net you have, the better. And also you got to look at your tax brackets. The higher brackets pay more money, of course, right? So one W-2, one deal, that's one person that's an entrepreneur, one person's a W-2 employee, and then as the business evolves, maybe the second person comes into the business. Depends on how lucrative their W-2 job is, right? Business expenses, meals, transportation, medical, retirement, the land you're on, the equipment, entertainment, utilities. Those are all things that are going to be business expenses, and you need to know how they're allowed, what's allowed. For instance, meals I think are typically at 50%, where lodging might be at 100%. You can read between the lines on how you might want to lay all that down on what it is, but be able to back it up if you're audited, and because it's the right thing to do. 179, now I'm not an accounting expert, but I believe it's called the 179. It's been around since, I think, Bush Jr. through the Obama administration. I think it's still in place, but there's usually something like it. And it's a way to expense your equipment out in a given year. And that could be a heavy vehicle. It could be a piece of construction equipment, a piece of manufacturing equipment. You can expense that out instead of depreciating it over time. You can expense it out, bang. The other thing I would discuss with you is use your 401k, your simple. If you work for an employer, for crying out loud, get that match from them. If they're given 3, at bare minimum, you better be putting in 3. So now you got 6% that in essence is tax-free money at that point in time. So your typical 401 or your simple, now there are Roths and they run differently, assuming Congress doesn't change their mind. So a 401 IRA, you're putting the money in and it's deducted from your income. So you can sock that money away for your future, and if you're lucky, your employer, or maybe you're your own employer, do the 3% match. So you're doing 3 and 3, you're getting 6. That's actually reducing your taxable income. It's free money, so to speak, and then it's going to sit there and it's going to make interest depending on how aggressive your investments are. I invest like I'm 18, even though I'm over 60. I still do aggressive investing. Someday when I'm ready to hang it up, maybe I'll go to money markets and bonds, but not today. So get as much as you can out of that. And every time you get a raise or you cut costs, add some more money. Get that thing up 15, 20%. That's something that'll help you keep your money and help feather your nest for the future. I wish you the best. This again is Rick Day, and this is Optimum Success. Thanks for joining me.